Hey everyone, so in this current segment, we'll be talking about order blocks and how do we identify quality order blocks that we can utilize in our trading. Alright, so what are order blocks? Basically, order block refers to specific price areas where large market participants, such as institutional traders, they previously place significant buy or sell orders. So on the chart, basically, right, we can observe the previous price action and looking for areas where price experience significant movement or sudden change in direction, which will cause price inefficiency. Right, so the two types of order blocks that we can look at is basically bullish order blocks or demand, which are areas where we look for buys or to go long, or bearish order block or supply, which are areas where we look to go short or sell. So in the graphical example, of course, right, like over here on the consolidation area is normally where orders will be gathered. And once price breaks to the upside, right, this is where price inefficiency is formed, where there's market gaps, fair value gaps, imbalance, all that. And once price retest this area here, especially, this is where we can start placing our longs. Whereas on the sell bearish order block, when of course market orders are being collected here and price break to the downside, it forms inefficiency, fair value gaps here. And when price comes back to this level again, this is where we can go short. How do we exactly draw order blocks? So remember that they are concentrated or consolidated areas before a huge movement by market makers, where of course there's market inefficiencies like fair value gaps and imbalance. So like for example, with regards to the demand zone, right, we are able to draw it somewhere at this level, right, where of course there's a huge move right off this point, right? So this is where we can start drawing first on our bullish order block. Then likewise, other than this, we can draw it here as well. This is a very significant level, right? Because once it's a consolidated area, there's a movement here. So we can draw it here as well, right? So these are relatively two rough points that we can draw. We can also draw it right at this point over here itself, correct? So if we move back a bit, we can draw there are areas here as well. After a huge move, there are areas here as well, and areas here as well. So this is the final point, right, which connects, because once there is a huge move, there's imbalances here. So this is for the demand side. So likewise for our bearish order block or our supply, you can find the other way around where there's a huge move downwards. So a very clear move is somewhere over here, right? This is where there's a very huge move to the downside, especially. Right, so this is one over here. We can draw one that's right here as well. And we are able to connect one from here as well. Correct. So this is a small consolidated area with a huge move. Okay, so with that, of course, let's see how, like when we have sketched almost every order block, let's see how one should look like. So this is basically how the chart will look like as a whole. We can see that there's a couple of demand zones, right, of a consolidated area. This is one as well. This is one as well, which didn't get taken. This is one after a huge move. And this is one here after a huge move. Correct? So, right, like given that, of course, now we have roughly sketched our order blocks. So this is from a H4 time frame, correct? So in the next segment, we'll just be talking about like how do we exactly catch a high quality order blocks. Okay, so let's look at some things to consider when selecting order block. So basically, the very first thing we look at is market structure. Of course, whether or not it is uptrend or downtrend. So basically, of course, in the graphical example, we can see, right, that when it comes to the uptrend, right, the demand order block is getting respected and the supply order block is getting breached. Where in this case, it's forming a higher low, a higher low, a higher high, a higher low again, and a higher high. Whereas with regards to the downtrend, you can see that it is the other way around, where with price forming new lower low and lower high, you can see that demand is continually getting breached and supply is the one being in control. So of course, with that being said, how can we apply this to the real example? So it's preferably the same thing as well, right? That we can see that, of course, in this case, right, when we are looking at trades when it comes to the uptrend, it's better for us to trade from a demand zone. Whereas when it comes to a downtrend, it's better for us to take from a supply zone. So right off this bat here, we can see that with higher structures breaking here and higher structures breaking here, of course, this demand zone is probably will be a quality trade POI, right? Because ultimately structure is breaking to the upside. This supply zone will not be as strong because technically, yeah, the trend might be changing at this level. And likewise here as well, right? With new higher high forming, higher low forming, higher low forming, high high forming, right? So this supply is ineffective. This demand is relatively strong. So like at this level here also we can clearly see, right, that of course over here this demand is still very uncertain yet, right? However, of course, once it gets reached already, so from here onwards, we should be trading from supplies instead. So this is one quality POI here that we have identified. Another POI quality that is deemed seemingly good enough is, of course, from this level here, right? Because structure has broken here, structure has broken here, supply is getting respected, supply is getting respected here as well, correct? So likewise, after this break of the structure here, supply got respected here, 1, 2, and 3, and so on. All right, so now for the next point, of course, we have to also consider whether or not there's gap or liquidity resting below the said order block. Because obviously, if there's gaps and liquidity, like markets is very likely to look for it instead before it sweeps back up again. So we can see like right off the bat, like there are a couple of examples where, of course, there is a couple of liquidity that's been present. Like example over here, we can potentially draw like a demand a demand zone right off here as well, right? Where of course, even though there's a demand zone, but this set level could be seen as liquidity. Or like even for here as well, right? There's a liquidity resting here as well. So in all of this level, there's indeed a POI that's resting here, right? There's a demand zone that's been here, but you can see that there's gap, there's liquidity that's been present here, and there's a POI here at the bottom. Right. So likewise for this level here as well, even though this demand chain, this did really form a chain, but however, of course, there's liquidity that's resting here, and there's liquidity. Ultimately, this became liquidity that's resting as a whole. So this caused the trade to continue its way up all the way again. Because it doesn't exactly like it's not all the time that this is accurate also because like sometimes of course even though there isn't really much liquidity back here, but like where of course price went all the way down here, but price still continued this on its way up. So this shows that the trend is still pretty prevalent as a whole because by the time price has gotten here, the uptrend was relatively pretty strong as well. Right. So we can see here, right, that this is a great example that even though there's a POI, there's a supply zone that's over here, right? But ultimately, of course, there's a gap and there's an existing POI here. So naturally, this POI is not as strong as compared to this level here as well. Correct. So likewise, even though there's a supply chain that is being formed like over here, ultimately there's a supply zone right above this supply which got swept as a whole as a result for it to continue its way down. The very third pointer we can go to is of course whether or not the order block is recent. Because if it's the most recent one, is gonna be if the order block is the most recent one, it'll generally be more stronger as compared to if it was already mitigated before or whether or not it is very far away. So like a very clear cut, clean example will be, of course, likewise over this level here, right? Where at this immediate, there's an immediate demand chain being formed. There's an immediate demand, there's an immediate demand chain that's being formed at this level here, right? Where we can see that almost immediately, of course, the demand chain one here, reaction here, demand chain two, reaction here, then it comes up again. Because let's say by the time, of course, price do get back here again, this is the most recent demand chain where price reacted to. But ultimately, when there's multiple touches of this demand zone, the demand eventually got breached again to the next equivalent demand zone below, right? Then ultimately it's the same here as well. Even though like there's a demand zone right here, and this demand zone did successfully have a reaction, but ultimately price did breach all the way down to follow the long-term movement itself. Right? So this is a very good example when, of course, when there's a very clear break in the structure to the upside, price, of course, came down to test this demand zone again before it comes up. And ultimately, when price do revisit this back to this demand zone again, it ultimately fails. Right? So of course, this demand has lesser effect on these levels because it is already pretty far away from this level here as well. Okay, so you can see right that ultimately over here, even though like there's some sort of reaction, but this zone technically did respect this level of supply of bearish order block here as well. So this ultimately swept this liquidity to tap on this order block before it came back and touch again, before it break again. There's generally two types of order block that we look for: demand, where we go for longs, and supply, where we go for short. So how do we exactly draw it? Is basically the concentrated areas before a huge movement where there's market inefficiency like gaps. So this screenshot is basically, of course, some quick fire examples that one can refer to. And next, of course, some things to consider accordingly when choosing the said order blocks. Just to recap, of course, the very first thing we look at is market structure, where on the uptrend, demand is in control, supply is getting breached. On the downtrend, supply is in control, and demand is getting breached, right? Then next, of course, we have to see if there's existing gap or liquidity resting below the order block in question. Because if there is a area of liquidity resting, chances are markets might potentially sweep it off before, of course, entering a trade. Before price goes the opposite direction as a whole, right? Your stop loss might become the liquidity point. Next, of course, you also have to choose the recent order block. Consider whether or not the order block that's being in play is the most recent, right? Because if you are going to stretch from all the way from the past again, chances are it's just going to be a typical structure or liquidity for markets to target as a whole, making it not as effective as possible. So with that, thank you very much. I hope that this lesson on order blocks has been relatively useful. And please like, share, and subscribe, and do comment down below.